As Mike said, I'm a student here. I'm a senior. My name is Holly Hunt in Fire, and it is my pleasure to introduce our next speaker, Mr. Mark Gibson. Mark is currently the CEO of Global Capital Markets at JLL, where he leads nearly 2,000 capital markets professionals across the U.S., Canada, and Latin America. He also shares responsibility for the strategic direction, growth, and client activities of JLL's global capital markets business. As well, he is a member of the firm's Global Capital Markets Board. Prior to joining JLL, Mark was a founding partner of HFF, having served as the director and vice chairman during the company's IPO in 2007, and in 2014, he later became the CEO of HFF. Please join me in welcoming a true giant in the commercial real estate industry, Mr. Mark Gibson.
I think after that introduction, it goes downhill, so I just want to set expectations. I don't know about giant in anything, but I'll do the best I can to reason together. So we're pricing $200 billion a day of commercial real estate. So what I'm going to give you is just what we're seeing. It's not opinion. Opinion could come through Q&A. You should discount it if it's my opinion, but we'll tell you what we're seeing and where the flows are going, and we'll just give a broad picture. It's very hard to soundbite the commercial real estate business, because if you just think about how multi-housing performs versus office, that's different. If you think about San Francisco and how San Francisco is performing versus Miami, that's different. So it's really hard to get up here and just soundbite anything, and everybody loves a soundbite, but it's a little hard. But we're going to do the best we can to generalize what we're seeing. So I start with a few provocative concepts. One is work from home, rendering the office non-institutional. Nothing could be further from the truth. Every CEO with the largest leasing company in the United States, we actually have 45,000 people in the U.S., so in and of ourselves, it's interesting to manage. So you have the largest office and tenant rep business in the U.S., and every CEO of every major occupier across every industry is going to work from work. So if you want a job, we're going to work at work. And the misnomer is that it's young people that really want to stay at home, and that's the furthest thing from the truth. It's actually someone that can afford a little larger home or a second home that is having the greatest difficulty. The young folks want to be trained, they want to learn, they want to network, highly social, and they want to be in the office. In fact, we would lose all of our young people if they couldn't come into an environment and collaborate and meet people and learn and do things like that. So a very different story. It just so happens that that group that can afford a larger home or a second home also is the highest salary and the highest G&A, which in a cost-cutting environment, which we are rapidly entering into, is interesting. So that whole narrative is false, but we are going to have flex work, and that's a good thing. We're a little more efficient, so particularly in high commute markets, you'll see that'll be, we think, very beneficial to keep more people in the labor force. So that is a good, interesting construct when you think about the office. What we have seen is we have seen office users not downsize in space needs, and that would be contrary to what you hear, as you can see in point number, I guess, 2 there. Minimal space contraction so far, but what we have seen in the work from home scenario, and the technology industry was the first to see it, which is why they were the first to call everybody back, is that we have lost massive productivity gains. So labor productivity across every industry has been falling pretty darn rapidly. And we're beginning to, has anybody been to New York lately? What was your experience in New York? Mass 2019. I would add one thing, the traffic is nightmarish. So that is interesting in and of itself, that you see an urban metro like New York coming back the way it has. But there's one other driver. So no matter where you end up on this debate with office, if we don't get people back to the work environment, the tax base of our major cities in the United States is going to evaporate. This is way beyond commercial real estate. Retailers go out of business, clothiers go out of business, restaurants go out of business, crime increases, all of those various aspects. So we have to think of it a little differently. So office, while everyone is talking negatively about it, we're actually not negative for a host of reasons. Retail, it's losing its institutional premise or standing in the market. Nothing could be further from the truth. In fact, it's gaining more capital allocation than we've seen in probably 10 years. And the reason is pretty simple. If you survived the pandemic and your business model withstood the pandemic, that's pretty defensive. So it's actually gaining quite a bit more institutional inflows than some of the other in-favor product types. Now, we have seen spending decline because we are heading toward a difficult economic environment from a recessionary standpoint, and it's gone more to necessity-based spending versus experiential. But nevertheless, it's very much in favor. If you go to the suburban flight will end the urban gateway dominance, don't think so, for a host of reasons. We're already seeing in-migration back to cities like New York, et cetera. Rents are increasing across the board, but it doesn't diminish the fact that they have a lot of headwinds either. And the fast growth markets will continue to be fast growth markets. That is it'll shock you, that's a 100-year demographic trend. And I'll show you a slide in terms of population shifting south from the north, south, and from the west inward to western states. So when we make these statements, there's massive data behind it. And real estate just is dependent upon population and employment growth. So we have to see where that is going in the U.S. And then on the far right, you see distressed transactions will be robust. And I heard the panel up here a minute ago. We don't think that's the case. It wasn't the case in 08, 09 because the federal government and the banks did a very good job managing through it. We think the only distress of scale in the United States in commercial real estate, at least what we can see for the next year, is going to be in the office sector for a host of reasons. So there will be significant dislocation in office, but it's certain components of office. Maybe we can hit that in a Q&A. So in terms of where we stand in commercial real estate, I'm going to give you some themes up front, and then I'm going to show you some third-party information to validate what we're saying here. So if we just take a breath for a minute, why are we in the position we're in? And the reason is we have a common enemy, and that enemy is inflation. And the Fed used its primary tool to combat it, which, by the way, inflation was unsustainable. The costs were going up so high in every industry that we as a country, it was unsustainable. We had to stop it. So the Fed did what it had to do in the time frame it had to do it. And it's pretty painful now because they're saying it's going to be higher for longer. But just think about that. So the enemy is inflation, and inflation has actually trended down dramatically over the last year. So the question that all of us should be asking is not higher for longer, but what was the root cause for the rate increase? Why do we have an inverted yield curve in the bond market? And what happens when that reverses? So I'll just give you some thoughts of some fairly large owners of capital and their views. Their views are, once it becomes obvious that inflation is hit, which the only debate is what time frame, the yield curve normalizes pretty quickly. The Fed generally overcorrects. Historically, they've overcorrected every cycle because they have backward-looking data. They're 9 to 12 months in the past. They're very smart people. They're just quantitative analytic oriented, and they're not in the present. And so they miss it, and when they miss it, they dramatically drop rates to try and correct back to the overcorrection. And I have a slide in here that will illustrate that very clearly. So a lot of folks are looking at this going, well, when do we think that's going to be? And if we believe that will happen at some point in time, and if we believe we'll conquer inflation at some point in time, we ought to be buying today. Because if that happens, real estate self-corrects. Pretty much everything but office, because we have a cost of capital issue that is affecting value and affecting loan maturities and loan values and things like that. So that is what is happening in the world of institutional capital and large state plans and sovereign wealth fund thinking. Recession risk is by far the predominant risk they're underwriting versus inflation risk today. So inflation risk is sort of in the rearview mirror, even though everyone's talking about it. People are much more concerned about recession risk and demand waning, which we haven't really seen that much demand waning, but it could happen. Price rationalization, when we look at where the 10-year bond is going to ultimately go, the 10-year bond is really important for commercial real estate. It's what we index off of, total return, which is how people make investment decisions. So we have to watch that 10-year bond, and right now it's about 4.25%. It's up 80 basis points in the last 45 days. And everybody goes, well, why is it up 85 basis points if inflation looks like it's going in the right direction? And the answer is several things. One, we didn't get our act together as a country to agree to a funding budget for the U.S. Treasury until June of this year, which forced the U.S. Treasury to borrow $1.8 trillion within a very condensed time frame. At the same time, our largest buyers of U.S. bonds backed up for very different reasons. Those would be China and Japan. And now we have a new budget crisis. So all of those risks and supply-demand characteristics are affecting the bond market, and nobody really knows how we're going to end up. If anybody tells you they do, they don't. But smart folks with a lot of capital at risk are saying we need to see those risks go away and we'll see where the market settles. But a lot of them are saying we believe it will settle downward. We believe the Fed will conquer inflation. So we're going to make the bet now. And I know transactional volume was down, which it is down 60%, but I think over the next 2 quarters, we're going to see that dramatically shift for a host of reasons. Cap rates are indexed off that 10-year bond, so if we think it's going to be 3.5, which is where most of them think it's going to be, we're going to trade in the 4 to 6% range, generally speaking, long term. Volumes are down 60% because we have a bid-ask gap that was being talked about when I walked in. That is true. Anytime you have a fast shifting cost of capital, everybody pauses. That's common sense. You sit back because you don't know exactly what to do. You don't want to look foolish to invest now if you think the cost of capital is going to be higher in a quarter. But you also don't want to miss it. So everybody's got a little FOMO right now going, when is the right time to start investing? The buyer-seller profile is very similar to what I've seen over multiple cycles, which is it's always the institution selling first and the private buyers buying first. So right now, the high net worth families that don't go to committees, they don't have to answer a bunch of questions about inflation, they don't have to be pseudo-economists, they don't have to think about all these various components, they just see a good real estate deal. When they see one, they buy it. And when I talk about high net worth families, I'm not talking about what most of us would think is high net worth. I'm talking 200 to 500 million of equity per transaction, massive amounts of wealth, and I will show you a slide of what that looks like. And they are making very significant plays in out-of-favor property types that people just can't get their head around right now, like New York City office and other markets like it. So they are moving robustly. So you have sellers on the institutional side, buyers on the private side. We'll see how that moderates over the next 2 quarters. Because of that dynamic, where your large institutional capital is not deploying at the scale they were deploying, is the way to say it, anything above 150 million in commercial real estate is not trading very efficiently, meaning you're not getting the best pricing. So you're getting actually a portfolio discount. Anything under 150 million, because of private syndication, you're getting better execution. So we do a lot of very large transactions, $1 billion and $2 billion and things like that. We do a lot of small ones too. But on the large ones, we're saying just break it up. Sell it individual asset by individual asset, you'll get a much better price. And some of them agree with that and some of them don't, depending upon what they're trying to achieve. Another scenario that we're actually advising operators and capital to do is, does anyone think we have too much housing in the U.S.? Raise your hand if you think we have too much housing. Gosh, I was hoping you'd have a debate about that. All right. We have this government program called Build Back Better. We have more billion, $2 billion, $3 billion, $20 billion manufacturing facilities being built in the U.S. than we've seen in decades. because we have a national security issue called supply chains. So does anybody doubt that we need more industrial space? So we know that. We know there's tailwinds. We know that there's going to be demand. We know we might go through a recession to get there. But ultimately, we know there's going to be a demand. So if you really have the risk tolerance, we're advising folks, you got to be thinking about 25, 26, 27. And building today on industrial and multi-housing, despite everybody knowing what I just said, is down 80 to 90% because the return on cost metrics don't work. And capital doesn't want to do it because they're going risk off. So it's interesting. And that's a thought that we should think about in terms of where the long-term trends are going and what could we do today to address what we might think could happen in the next 2 to 3 years. I'm going to skip to the far right and just talk about fundraising challenges. We, at this moment, there's no league tables, but we're the largest placement agent, so we raise closed-end and open-ended funds for large institutions and operators. And it's challenging because, ironically, in the United States today, we have the highest amount of dry powder, so discretionary capital to invest in commercial real estate in U.S. history. So there's more capital to invest than we've ever seen in U.S. history, so therefore, when we're raising new funds, they go, well, why are we going to give you more money if you haven't deployed what I've already given you? Because no one is investing currently, so that's challenging. But the other thing that is happening here is we have a convergence of large institutional capital, LPs, and owner-operators. So we are merging capital and disintermediating, historically, what has been the advisor or the investment manager. And 80% of capital going forward of your large owners of capital will be on a direct basis to an owner-operator for a host of reasons. But that business model shift is significant, and we're working over 100 platforms currently and recapitalizing owner-operators with different forms of capital structures to take advantage of this. So that is a very broad overview of commercial real estate. People ask us, and I hear this a lot, they go, geez, there's just no capital. The banks aren't lending, things aren't happening. And I go, that's false. There's more capital than you can, there's no lack of liquidity. You just won't like it. Okay, you won't like the cost and you won't like the structure, but there's ample capital for commercial real estate, which is interesting for us. I won't go through these because we're going to clip it at a little higher clip now, but I'll just say this. The banks have come under scrutiny for a host of reasons, but I just want to explain what they're doing. And maybe this is an easy way to say it. Well, our normal run rate in the debt market is we do $1.9 billion a week in a normal environment of closed transactions. We're doing $1.1 billion a week today, and banks are 30% of that volume. So the fact, if someone states they're not lending, that's not true. So they are lending. It's just they have an issue, and the issue is their business model is that they commit $100 every year to deploying commercial real estate, but they anticipate that they will be paid off 2/3 of that book. So it's a running, you're on a treadmill trying to get more loans, because a lot of it's construction loans. You build it, you get paid off, they sell it, you get lots of things happening. And when the market shifted so radically, that didn't happen. So now they're committed, but they committed based upon payoffs, and those payoffs didn't happen, so now they're stuck. And they're at allocation to commercial real estate. So what would you do if you were a bank? You'd be a little more conservative. You'd take care of your existing clients, but you would do something else. If I'm going to give you $1 of loan in the marketplace, I want more back than just interest. So today, if you don't give them deposits and you don't give them your treasury business and you don't give them your wealth management business and they don't get a better ROI from you than they could from someone else, you're not going to get any credit. And that is exactly what is happening in the bank world, which is smart. But we're beginning to see that loosen up, particularly the money center banks. So I think you'll see them much more active in the future. We just closed a $1 billion loan portfolio. It was publicly announced. We didn't announce it publicly, but it was publicly announced. Where Capital One sold $1 billion worth of loans, office loans primarily in the Northeast, in New York City, and we sold it to Fortress. The interesting thing is Capital One wanted to do it and sold the loans because they want to go on offense. And we had 3 bids at $1 billion, and so when people say no one's investing in office, but yet I have 3 bids buying office in one of the most difficult markets to buy office in New York, that's interesting. And we have 3 more behind this. So what the banks are doing also is they're getting aggressive and getting out ahead of this a little bit and trading some of their loan portfolios in order to create liquidity so they can come back in the market a little sooner to lend. So now I'm going to just give you a few snippets of what I've said, and you can visualize it, which makes it a little easier. So here's your transaction volume. So we peaked at $743 billion. We're $147 billion year to date. We're down 60%. Bid-ask gap. No one knows exactly what to do. The sellers are going, no, I'm going to wait for things to normalize. Buyers are going, good luck. And we have this gap. But that gap is going to narrow, and it is narrowing right now. So we're expecting transactional volume actually to increase over the next 2 quarters. If you look to the far right, in 2007, which was the precursor to the great financial crisis, which we had just taken our company public, and we had told the market in 2008, this makes us really nervous because capital was too cheap. No one was evaluating risk properly. There was a lot of weird things going on in underwriting in 2007, and it was all very large trades that were happening, and that was also a sign of risk for us. Well, now you can see that 74% of the trades are one-off transactions across the board, and I can tell you that for me, this seems much more rational market because people are appropriately valuing and looking at risk versus the last 3 years. The last 3 years were the anomaly. I didn't understand cost of capital, number one, just due to the pandemic and the surplus and various other things that we saw. I also didn't understand the risk underwriting tolerance that we're beginning to see. Here, it's a little more normal behavior from an investment standpoint. There were some big trades happening. We're involved in several of these. And the only reason I bring it up is to show you the differences between trade volumes in multi-housing and industrial versus a hospitality or retail or even an office. Office is by far the largest product type by square footage and historically value in the United States. But look at the delta there. It's very, very interesting. But you do have a lot of these large trades. You can see Blackstone at the top on several of them that skew the data. So we have to back that out when we look at real transactional volume. Alternatives are all things like data centers and life sciences and manufactured housing and medical office and self-storage, and they are in favor, generally speaking, in the marketplace. And we've seen funds emerge and operators emerge that specialize in these. But the delta between volumes in this space, if you aggregated all of these up, with the exception of single-family homes for rent, if you added them all up, they would not equal one of our property sectors that I just showed you. So trying to move the needle in an investment portfolio by focusing exclusively on one of these is difficult. So there has to be a little different mindset there. But they're taking a growing share of the marketplace, as you see on the right. Mixed-use assets. So mixed use is you have multiple uses. You got retail, you got hospitality, you got office, you got multi-housing, you got live, work, play, all there. So you can see the absorption data, and I'm just going to hit the highlight here. So since the pandemic, 5.1 million square feet of absorption. If you take comparables that are not in a mixed-use setting, in the same locations and same submarkets, negative absorption of 221 million feet. So that's a pretty stunning statement. And rents are about 30% higher in every product in a mixed-use environment. So we're very bullish on mixed use. Those take longer to do, and we're very active in it. And we've shown you some of the more interesting mixed-use submarkets in our major cities across the U.S. On the equity front, what we look at is resiliency. So I don't look at league tables. Blackstone is at the top on the buy side. I'm really only looking at the buy side here, and the reason Prologis is up there is because Prologis and Blackstone did a trade. We're looking at the colors because the colors give us diversification, and we don't want to be concentrated to a single flavor of equity or a single flavor of debt. And as you can see, we got equity funds, we got the REITs playing, we got high net worth, we've got overseas investors, we've got lots of different players on the buy side. So that's comforting for all of us. You never want to be concentrated into a single group and what happens to that group if we can't get capital flows from them. Dry powder at record levels. So I made the statement. Many of you probably snickered at it and going, doubtful, but he's up there talking. I can't challenge him on it. But there you go. Now, what has it done to fundraising? Fundraising is the blue line. And it's exactly what I stated, because why give more money if you already have more money and you're not investing? So that is part of a challenge if you're out raising money. This is the allocations to hard assets from institutional investors. So you can see a massive doubling between 2010 and 2015 and a steady uptick. We think you're going to see another uptick over the next 5 years for a host of reasons. So these allocations are 11%. That is an average. It's the best data we have. But in actuality, most of your large pension plans and others are going to 15%. So keep that in mind when I talk about the overseas investors in a minute. The bigger are getting bigger. Scale matters. So when you look at the average fund size in 2022 at $510 billion versus where it has been any time in U.S. history, pretty dramatic shift. And if you look to the right and you look at Blackstone and how much money they and Brookfield have raised at 52 and 49 billion versus the rounding out of the top 10 here, and you look at Angelo Gordon, that's a pretty big disparity. So you see consolidation across all industries in the United States. They're consolidating vendors. They don't want to do as much with as many. They want to do more with those that can do more for them. So that is happening across the industry. These are the open-end and closed-end fund numbers. So the open-end funds are theoretically no duration, so they're open-end. There's no end to them. And the closed-end vehicles are generally 10-year finite life funds. And you can see the growth in both since 2007, the amount of money that exists there. Just pause here for a minute and look at this slide. So these are your largest overseas investors. And I showed you an 11.3% average investment across the board of major funds. But if you look here and you look at CalSTRS, which is our second largest fund in the U.S. at $314 billion, second from the bottom, and you look at CalPERS, which I think is 8 or 9 from the bottom at $497 billion, those are our two largest state plans in the United States, compared to Japan Post at $2.6 trillion. But what really matters here is not the aggregate size. What matters is the percentage allocated and invested in commercial real estate. So where do you think the runway is? That's pretty big. So we're seeing this capital flow into the U.S. We have a little problem, though. And the problem, here's the aggregate capital here. It shows you by country. And the Canadians are generally the largest investors in the U.S. But look at the fall off from $83 billion in 2018 to where we are today. And everybody's going, well, geez, you know, if they have this much money and we have the most resilient economy, which we do, and this is where they want to be for a host of reasons, what's happening here? And what's happening here is this, which are hedging costs. So the strong U.S. dollar has given us a problem. So if you look at Japan, and ironically, we're doing a lot with Japan in the U.S. right now, which is a little shocking at the very bottom. So you can see they have almost a negative 4% play in hedging costs. So if you buy an industrial project at 5 and you lose 4, that doesn't work. and you put leverage cost in there. So we have a little issue, and that's rectifying itself. It's gotten a little narrower up at the top, and we'll see this ebb and flow. What we really need is consistent monetary policy from the Fed, and we need consistent behavior in the bond market to correct some of this. We talked about high net worth, and I mentioned that I'm not talking about small high net worth, I'm talking about big high net worth. So you look at 11.9 trillion of high net worth family office that can be invested, and it's 2/3 of those offices were formed since 2000. They're acting and deploying like institutions, and we're doing a lot with them. And you would know all the names because they're household names, but they are very aggressive in the commercial real estate space. On the public market side, I did talk about pricing and how we have a differentiation on price due to all the factors that we have chatted about, but 150 million seems about the size where you get efficient trading, so M&A doesn't fit that. So we can't raise enough debt to do $1 billion or a $2 billion or a $3 billion trade efficiently. So M&A, and we're 6th in the US in M&A work across, so it's coming down, but we're doing a lot in the private market because of this business model change that I was mentioning earlier, which is pretty amazing. All of you probably know about BREIT. Does everybody understands BREIT? So Blackstone's mutual fund is the best way to describe it. So that's a whole new genre of capital being formed. The old model, if you invested $1, they took 16, not Blackstone, but the industry took 16 cents of that in fees. The new model, they take much less. It works, it's sustainable, and as a result of that, those various changes and a lot of overseas capital coming into this space, you see the euphoric rise in what we will call this non-traded REIT area. And then you see the dramatic decline. And the reason dramatically declines is they're investing for yield. And there are better options in the credit market today than maybe in the BREIT market. But we're going to see that stabilize, and we're already beginning to see it stabilize. On the debt front, very similar to equity in sales transactions, so down almost equally, 60% and 54%. It's going into multi-housing. Look at the difference in where the capital is going versus all other property types. So the liquidity, we do have to think about that, and it's coming from both the commercial banks and the agencies, which would be Fannie Mae and Freddie Mac to the left. So that's a good snapshot of who's doing what, providing and moving through it. On the equity front, I showed you who the buyers were, and we looked at colors. And I said, geez, it's just good to get diversified people playing in the commercial real estate industry because we don't want to be concentrated. Well, the same thing in debt. I want you to look down at the very bottom in 2007. 50% of all capital flows in the debt space in 2007 to commercial real estate were CMBS. And when that market went from 200 billion to 20, it crushed commercial real estate because we had no flow back to it. And that's not the case today. So if you look at the top, that's very consistent, very diversified funding sources for commercial real estate. So that should give us all a lot of comfort. I mentioned gateways not going away. And I mentioned fast growth markets not going away. And I mentioned a long-term trend. So let's just look at the fact set. So here's housing affordability to your right. We talked about that. And then we looked at some drivers of migration. I didn't really get into this at the beginning, but if you look at taxation, you look at regulation, you look at governance, you look at crime, you look at affordability, you look at a lot of things across the board, there are headwinds in some markets versus others. So that has shifted it, and you can see where these moves have gone, and real estate values follow population and employment growth. And the fact of the matter is that companies are moving across state lines at the fastest pace in U.S. history. And so if you're a real estate investor, you got to look at where that's going, and you want to go there and get ahead of it. I mentioned it's been 100 years of a trend. Well, here's the backup. So 1920, 60% of the population was in the Northeast and Midwest. It's shifted, and those trends have continued. And they accelerated during the pandemic. They've slowed a little bit but they're continuing at the normal pace that they have been playing. There is a new element here, and that is one of what we'll call innovation hubs. So primarily STEM-oriented talent, and we're looking at where those are, and it used to be 5 markets in the United States. So you can see those in the blue, and now you have a lot of options. So we have this concept in the workforce and in corporate America called distributed work. They may have a headquarters where they have 200 people in a given market, but all their headcount is distributed across the U.S. in a lot of different places. And that is a trend that is not going to back up. It's going to continue to accelerate. And then we look at market liquidity, and it's a little shocking to me to see Dallas-Fort Worth, which is about a third of the size of New York, have more liquidity. So when you look at these markets and you look at the relative size of commercial real estate and you look at the transactional velocity and you're an investor, you have to think about that. And that's what large-scale investors think about. It changes year to year, but directionally it's pretty much the same. I mentioned the high net worth folks are making plays today and buying real estate at a discount to replacement cost, and they can run IRRs as well as anyone. They just throw it away and they look at basis. And they go, we think this is going to be a good play. And we think it's going to be a good play because of this statistic. So just absorb this for a minute. So 5-year total returns by asset class. Real estate's never had a negative 5-year segment in 30 years. If you go to the far right and you look at the second bullet point, so we've outperformed corporate bonds and non-agency CMBS in 71% of the 5-year hold periods in the past 25 years, and outperformed S&P in half the periods, and not posted a negative total return in any 5-year construct. So when you see the largest amount of capital available in U.S. history, it's waiting to deploy because it doesn't know really what to do, because it's interesting times. The reason that it's formed and the reason the allocations are increasing is because we've performed. In hard assets, long term, there was a maverick in our industry, a person by the name of Jerry Hines. He formed the Hines Company, and I cold called him when I was 25 years old. And I said, you know, I'm a good beggar, and I was begging for some business. And he took this meeting, which is shocking, and I said, geez, you know, Mr. Hines, just give me a shot. And he's talking through it. He goes, Mark, I tell you what, I'm going to give you a shot, but I'm going to give you something better. He goes, I'm going to give you some advice. And I go, great. What's the advice? He goes, you know, if you buy or build really good real estate and you don't over leverage it so you survive the cycles, because real estate's a cyclical business. We haven't seen it in a long time, but it is a cyclical business. Because then you don't over leverage so you survive the cycles. It always goes up. And I go, that's great, Mr. Hines. If I ever have any money, I'll take that into consideration. I don't have any, so please give me something that I can go do something with. So we have a long-term way of performing here. On pricing, you got to look at supply. We have excess supply in the multi-housing business, and the industrial business is going to hit the market in the next 18 months. So rents, particularly in the multi-housing business, are likely to decline, and we may have negative net effective rents in certain markets because of supply. But as I just told you, supply is over. In 25, 26, the first movers are going to get really well rewarded because we need more housing. And the question is, what kind of housing do we need? And that's a debate that I'm in the middle of a lot. The only statistic that's reasonably accurate is this one. You look at REIT values, and it kind of correlates with cost. Let me just tell you what we're seeing. We do more to-be-built product in the United States, capitalizing it, than anyone. And we're seeing costs down 8 to 10% across the U.S., depending upon exactly what we're talking about. The only thing where costs are not down is primarily concrete, because we're competing with the federal government on Build Back Better. If you're going to borrow money, everyone goes, well, where do you think rates are going? Who knows? No one knows. But we can give you some rational views. Look to your far left. We looked at 2018 Those were your average in the SOFR, the 5-year bond, and the 10-year bond. Then 21, which we view as an anomaly. Then where were we in in March 15th through April 15th, and where are we currently? And I just want to highlight something here, is what we're telling people, I don't really care where rates settle, I need them to settle. The bond market is more volatile than it's been in a long, long time in my career. What business needs is consistency of pricing. So when we found that in March of 15th through May of 15th, and the 10-year stayed at about 3.5, our transactional volume went up 3.5%. I'm going to show you some slides on that. So we just need stability. So the question for all of you, these spreads in the middle are our actual spreads. We're the largest debt intermediary in the U.S. And if you look to the right, you got to ask a question. Here's a benchmark, so pre-pandemic, before any of this happened. Then we had an anomaly during the pandemic. Then we had this March, May, which is more where the institutional market is lining up that will end up. And here's where we are today. So what do you do with that? That's where we're spending a lot of time on advice with folks consuming debt today. I mentioned the Fed's actions. So this is Fed increases and Fed decreases. So we just raised it, the fastest increase in U.S. history. And you can see that on average, 23-month period from start to finish is what the Fed does. They hold on average for 9 months, and then they go, my gosh, we overcorrected because they have backward-looking data, and now we got to drop really fast, or we're going to go into a much deeper recession than we thought. That's the trend line. So that is what a lot of folks are looking at. Well, when is that going to happen? Well, if you do the math and you look on an average of 23 months, could be shorter this time because it went so fast, and you look at a 9-month hold, that puts you in first quarter of 24. Bloomberg is predicting in the red box a 3.88 bond by December. That's a 50 basis point decline from where we are today. Who knows? They're never right. I don't know. But the forward curve is suggesting the same thing, and it's never right, but it is the largest trading market in the world, so we have to look at it. But that is predicting essentially something very similar. Cap rates on average, I mentioned the 10-year bond. I'm going to close here pretty quickly. So the 10-year bond, on average, we have 150 to 200 basis points above the 10-year bond for a cap rate, generally speaking. So that puts us 4 to 6%. We maintained discipline even when rates went really low in most product types, but not all. And so that's causing us a little problem. So I'll just pick on 2 of these right now. Let's look at retail, that in year-end 19, which was a benchmark year pre-pandemic, cap rates were 5.25 to 6.25. Not much different today. We have a lot of transactional volume in the U.S. So expectations really weren't changed all that much because look at the peak. They didn't drop that much. But if you look at multi-housing and you look at where they were trading at the peak versus where they are today, and you look at leverage returns, it's had the most price correction. And so the trades in the multi area are a little more difficult than they are in some others that didn't shift quite as much. And these rent growths and exit caps below, the only reason I put this in here, and you're welcome to have a copy of these, by the way, so you can study at your leisure. I'm going through them pretty quick. Is now where we are today on these exits and all these underwriting criteria, they're reflecting a recession. So rent growth is very moderate to negative. Exit cap rates are higher, all of these things, which is exasperating the bid-ask spread gap. This is my favorite slide, only because the institutions like it, which is the total return. So in 2007, we knew we were in trouble when 2/3 of the total return was in capital appreciation, and they were underwriting 10% rent growth for 3 or 4 years, buying something at a 4 cap and exiting it at a 3 cap, and we're going, that doesn't make sense. And we called it out on a public earnings call because it didn't make sense to us. And yet we were back there in 21. And that made us very nervous. When I said I was uncomfortable and I didn't understand it, that's why. So now we're back to where we were since the great financial crisis, where it's almost jumped back to 70% of the total return being from cash on cash and 30% being from residual gain and appreciation, but with very measured underwriting to get to that capital appreciation. Bid activity, I mentioned we saw stability when the bond hit 3.5, and these are the actual bids. So just look at the purple, the rest of them are by product type. So when you see April and May, and you see the average number of bids per asset that we're trading up, and then you look to the right and you can see the number of launches into the market of assets for sale, you can see what happens when you have stability in the bond market. Yikes, I missed a slide here. Anyway, there was another slide behind that showed you number of bids in totality, and it follows that exact metric here, which is just a very consistent cost of capital. People get comfort and they go, I can make a smart investment decision now, I'll go ahead and trade. So we saw transactional volumes up 30%. That is down 65 to 55%. Now, who knows what value is today in some property types, so that's a little suspect, but that is the best industry data that we can give you. And just a thought on this slide, which is if your cap rate that you bought at is 4%, and now you can sell it at 5%, to maintain the same value, your net income has to grow 25%. I love this slide when cap rates were going the other way, because I just want to remind everyone that if something changes, we're going to have an issue here. And the question is, when is that issue going to occur? So it's a pretty massive deal. We've seen a 25%, 15 to, we'll call it 25% diminution in values across all sectors. In some cases, we've seen 50 to 70% diminution in values. So when I talk about cyclicality, we always have to keep that methodology in mind. So I'm going to pause there because I think I'm pretty close, Mike, to the end. So let me pause there. And is there any more time, by the way?
We have about 5 to 10 minutes for
Q&A?
Yeah, we would love to launch into
Okay. I'm ready. Let's do it. I've bored people enough today. So let's see if there are any questions. Yes, sir.
I have a question. Let's just say half the people in this audience are students. They should either be terrified or excited, right, by what's going on in the market. 2 questions. Is JLL hiring? 2, who else should they be targeting as potential employers as they go into the workforce? We're going through a great change. It's going to create tremendous opportunity over the next year, 2, 3, based on the dynamics of the marketplace. Where should they be going looking for work?
So is JLL hiring? Just the capital markets side of it, we've hired 80 people in the last 4 months. We see things happening. At HFF, which is a company that myself and 2 other folks founded, sold it a few times. We took it public in 2007. We purposely had no debt, and we had a bunch of cash because when everyone was on defense, we wanted to be on offense. And that's where we are today. So most corporations, which you're going to see across the U.S., they're going to be, layoffs are going to accelerate, and we're going to go the other way. So that answers that question. Number 2 is that I think it's the best time. I heard the tail end of the previous panel talk about timing to come into the business and not into the business. You learn so much more in times like these than you do in good times. So this is the time to actually enter and learn. I mean, really what can happen. And it will make you a much better investor and a much better business person to learn some tough lessons today and see mistakes that were made. I mean, the mistakes that people made were, it was essentially free money and everybody thought it was going to last forever. And I've seen 3 cycles before, so it made me very nervous because I know that's not the case. But you have to learn it. It's not because I was smart, that's for darn sure. It's because I had seen it. So this is a really good time to enter and learned the real ups and downs of commercial real estate, or any business, frankly. But commercial real estate's what I've been in, and I think it's a brilliant time to jump into it. Yeah, Mike?
There were a couple of slides of the amount of foreign money coming into the United States.
Mm-hmm.
You showed some other slides of the high-growth markets like my hometown of Austin, Nashville, Charlotte. Traditionally, foreign money has hung out in the gateway markets. Are you guys starting to see the flows go into these high-growth markets from this kind of newish capital?
Yes. So the question, everybody hear the question? Okay, overseas capital going to smaller markets. They're not in South Bend yet. Just saying, they should be, but they're not. But yeah, why is that? Somebody answer it for me. Why would foreign capital be looking at Nashville or Denver or Phoenix or Austin or Tampa? Why would they be looking there? And the answer is population and employment growth. They are following people. So that demographic trend, they've gotten smart. So for years it was just because they knew New York, and you had direct flights to New York, and it was easy to go to New York, and you couldn't be criticized for New York. We get that. Real estate's great about acronyms. So we have gateway cities, but then we had 24-hour cities, and then we had supply constrained markets, and then we have all these acronyms. We have all this stuff, and it's for a period of time. What survives the test of time is migration and policies about migration. So we as real estate people have to be really sensitive to that and look at where businesses are going to go and why are they going to go that, because they're going to attract the population. And generally speaking, businesses are going to go where population is going to go for a host of reasons, because they want the talent pool. So it's a great question. Yes, sir. So I already hit one part of that, and that is the banks, but not CMBS, right? So we hit the banks, and we're talking about large amounts of capital forming to do loan sales, and I showed you. We've done two in the last 30 days, which are pretty big news. One was $1 billion in New York that I talked about. The other was $1.3 billion in medical office building loans that we just sold last week. That's going to happen, and it is happening. In the CMBS world, this is Groundhog Day for me, because all the private equity folks were saying, oh my God, we got this wall of maturities in 08, 09. We're going to have the biggest, unbelievable, most distressed buying opportunity known to man. Raise a lot of money, you do it. Didn't happen. It also didn't happen during the pandemic. So 3 strikes you're out type thing. There's a saying about that. This time around, yes, you have a wall of maturities, but what are going to people do? Because they understand what Jerry Hines told me a long time ago. If you have a good piece of real estate and you're upside down capital stack wise because the cost of capital came up, are you going to just trade it, or are you going to, if you have the ability to hold it, would you hold it and wait for prices to recover at some point in time, if it's the right real estate and if it's the right sponsor? The federal government has already given the banks the same latitude they gave them in 08, 09 to do an A-B structure. The same thing is going to exist in the CMBS world. You're going to start seeing structured trades in the CMBS world. But my thought is you're going to get a lot of workouts done versus large-scale portfolios trading in the CMBS world. In the bank world, they're very well capitalized, despite what you may read in the press. So they're going to trade them because they're tired of dealing with it and do something else with that capital. So it's a little hard to say it across the board, but generally speaking, in CMBS, I think you'll see more one-off trades, primarily in the marketplace. I don't think you'll see large portfolios, and I don't think it's nearly as bad as what you might have thought.
Mark,
I'm getting the hook. It's
no,
good.
No, not quite the opposite. One
Oh.
thing we didn't talk about. So Mark flew up here today from Dallas, Texas. Another Dallas native, Ed Capola, who is the CEO of Masterrich, he created the Capola lecture series. And so you are a distinguished fifth speaker, keynote in the lecture series. Roy Marsh, John Buck, Chris Merrill, and who am I missing, Dan? David Simon via COVID.
Well, you reached the bottom of the barrel when you invited me
No.
then, Michael.
I would
Something's wrong. You're slipping, man.
Yeah.
Something's
I've only been
wrong.
on the job for 2 months. If I'm slipping, I'm in
Okay,
trouble.
all right,
So,
there we go.
no, we can't thank you enough. This is, it is enlightening because you get so much bad news. And that first slide that you put up that said, here's a headline and here's the trid line, absolutely turned everything that I've been hearing on its head. And you're speaking from data, not from headlines. And so to us, I think anyone in this room, that becomes very valuable in seeing that, wait a second, there is still transactions. People are still working in offices. The building we're in is fairly new. This is about a 5-year-old building.
Cool building.
It's a cool building. The stadium that you're looking at has been around for 93 years. And
Cool stadium, too.
we're very proud of it. And so as a token of thanks, we pulled a seat out of the stadium, put your name on it, and hope that this has a good spot in your office in
That
Dallas.
is so awesome. That is
Yeah,
great.
so-
Thank you.
Thank you so much. I've had the privilege of listening to Mark speak. I've been a client of Mark's for the better part of 15 years. I learn something every time he speaks, and usually it's in the same vein that I just discussed. There's a conventional wisdom, and then Mark brings data. And as we know, data weighs out over conjecture at any time. So, Mark, thank you for being here. I know this was a quick in and out, and we appreciate it very much. Thank you so much, man. Thank you so much.